out with a situation where they bought bonds today with interest rates really low, and then inflation kicked in and the Fed changed its policy and raised rates, and now their bonds are worth less. How do you handle that?
Well, I believe a diversified portfolio helps clients to weigh through the times.
Okay.
And I also work with many of my clients in a bucket theory.
What does that mean, a bucket theory?
You have short-term money that you'll need to access more quickly. Yes, in a low interest rate environment. Mm-hmm. But if you know that your expenses are covered for a year or two or even 3 in CDs, money market accounts, treasuries, you're more confident as you go through volatility in the market to know that your bread and butter is still coming in every single month. So we look at a 1 to 3 year period, 3 to 8 year period, and then longer period. So you're not getting invested into the market when things are lower and going up, and then coming down drastically, as we've seen more than I'd care to remember over the past several years. And then making emotional decisions, because money is about emotion. Will we have enough? Is it going to last? Will it pay us enough? I remember going into the BP gas station when I was in the back seat of my dad's car, and gas was 28 cents a gallon. I just filled my car the other day, it was $3.59.
Right.
So that was probably in 1967. We did get a little green Dino soap at the same time, and that helped my family of 7 children. But you know, we have to anticipate our portfolios being invested for a lot longer. When my dad retired, he was 61 and a half, and his life expectancy, as probably your parents, because I think we're in a similar age bracket,
we are.
you know, was probably, if he had retired at the normal retirement age of 65, which is what his peers were doing, his life expectancy at that time was probably somewhere between 9 and 12 years. Unfortunately, my dad didn't get that long, but when we retire, we have a very high probability that we could live another 30 years, and maybe 35 years by the time that we retire. So it's not, I don't believe that it's feasible for us to think about taking our retirement money out of the market when we retire and stuffing it in the mattress and being able to live for a long period of time.
But you know, a lot of seniors or retired people have this mantra: income, income, income. I need income. I need to develop income. And of course, some people are talking about, well, the place to put your money to get the best yield today might be in the stock market because of the dividends that some of the blue chips are paying.
Yes.
But there's risk that goes along with that, isn't there?
There is risk.
Yeah.
So you look at, you know, if you're an older investor, then you're in a more conservative portfolio that has a fair amount of cash, a good amount of bonds, but the hedging is in the stock market.
Is there a place for annuities for somebody who's retiring? In other words, for the right person, should they be looking at either a variable annuity or an immediate annuity in terms of trying to develop that income stream for their retirement?
It's not an aspirin for everybody, but annuities do serve a purpose with certain people's portfolios. And I believe that they have gotten a, if I can say on TV, a bum rap over years, because many people think of it as you're putting $100,000 into a vehicle, and if you died the next day, you would not receive any income from that, nor would your family. And there is a option that you could do it that way. But when we're recommending them, we're usually looking at something that we call a period certain. So you might deposit that $100,000 into the annuity, and it would be paid out, and this could be your bucket number 1, over a 3, 5, 7, or 10-year period, and you're actually naming a beneficiary. So if you died the next day, the insurance company wouldn't end up with the money. Whoever you listed as the beneficiary would end up with the money, and the income would continue for them over time.
Well, given the level of interest rates, though, it would take a significant amount of money to put into talking about immediate annuity.
Yes, of course.
Put into an immediate annuity in order to create a current income stream, wouldn't it?
Correct, and that's why we use them for short periods of time.
All right.
So the balance of the money could be invested perhaps in a deferred annuity and a managed money platform. And the deferred annuities have actually even gotten positive press over time, because many of the insurance companies, and a lot of the insurance companies have actually gotten out of this business. There's still a few that we work with, but we like them with the living benefit guarantees on them.
Mm-hmm.
The customer ends up paying a little bit more in cost for that,
Mm-hmm.
but they are essentially getting a guarantee that they have income that they cannot outlive, regardless of what happens to the balance in the account.
Mm-hmm. Now, there's a rule of thumb that I've read about,
Mm-hmm.
that a retiree only needs 70% of his or her income. Is that a reasonable rule of thumb? And let me tell you why I'm asking, because it seems to me from the clients I have that they want to be pretty active in retirement. And if they're
Mm-hmm.
active, there's
Exactly.
cost associated
Mm-hmm.
with that.
Well, I, like you, probably don't deal with many average people.
Okay.
Well, everybody has high dreams of retirement.
Right.
Another thing my dad always told me was, don't put off your living for retirement. Try to live now.
Mm-hmm.
So I think that we've seen a little change in that trend. It had been somewhere between 70 and 80%. I don't know if we could put a blanket on everybody to say that you need 70%. You really have to take a look at what you'll need, and it goes back to that budget word. You know, many people are having second and third families
Mm-hmm.
entering into retirement. There might be child support, there could be alimony, you could be funding your children's education when you're 70. You could be taking on another mortgage when you're 60 years old. So depending on what everybody's situation is, would certainly define what percentage of their pre-retirement income that they needed in retirement. And many of us, I think that also ties back to thinking that our tax rates would be lower in retirement. What do you think about that?
What do I think about lower
Yes.
tax rates? I think tax rates are
In
going
retirement, exactly.
up. They're
I do
going up,
too.
yeah.
Yes.
So.
I don't know. It depends on everybody's situation. I am not a person that gives a blanket statement
Right,
that everybody
right.
should do one thing or another. It really goes back to the analysis. It goes back to the planning. It goes back to looking at things in a holistic manner to know and understand really what is your particular situation and what percentage of your income needs to be derived from your retirement savings.
From what colleagues of mine tell me, since the bursting of the credit bubble, the number of people 65 and older declaring bankruptcy has significantly increased.
Yes.
Which is, to me, a real worry. That means that they took on a lot more debt than they could handle,
Mm-hmm.
and they found themselves in trouble when the market went the other way on them.
Right.
You know.
And many had inadequate savings because maybe they were like the client that you cited
Mm-hmm.
before, that were, you know, earning a good income and spending every cent and maybe
Right.
more.
Right.
So they didn't save enough.
Well, I mean, I completely appreciate the idea of having a great life,
Mm-hmm.
but you also have to make sure that you have a great retirement too. And
I agree.
You have to kind of figure out how to balance that.
Mm-hmm.
And you know, as somebody who decides to live what I call the rich life or the high life and doesn't do any saving, I think that's a problem, because you know, in order to build a nest egg, you need to save.
Yes.
You know, and if you can get that savings to grow, well, that's a bonus. That's the way I look at that. That's
Mm-hmm.
a bonus. But first, you have to save.
Yes.
And people who don't save are going to find themselves in an awkward spot. And I also suspect that someday we'll see changes to Social Security, significant changes.
I agree. Yes.
And then on top of that, a lot of the private companies are converting defined benefit pension plans into 401ks, putting the responsibility
Absolutely.
on managing that money
Yes.
on the employee,
Yes.
the future retiree.
Mm-hmm.
So there's a lot to think about here, lots of moving parts.
Yes.
I think that's a good place for us to start.
Yes. Thank you.
While each person's financial needs and retirement plans will vary, everyone does need to review their retirement planning in the context of the current economic environment to make sure that their financial plan aligns with their personal goals. Preparing for retirement can be very complex. It is precisely for that reason that one needs to establish clearly defined retirement goals. Given today's slow growth economy, still troubled housing market, volatile stock market, low interest rates, and gloomy global economic reports, this is no doubt a time fraught with ongoing tension, weakness, and uncertainty. Retiring into such an economic environment is, to say the least, both challenging and stressful. Today we learned from Kristin Nordahl that establishing a safe withdrawal rate is crucial to assuring that your money will last throughout your retirement. Ms. Nordahl also mentioned considering certain types of financial products coming primarily from insurance companies which may help create a livable income stream. It is just as important to plan and adjust your spending side of the retirement equation. In so doing, you can prepare for your financial security retirement. Given the longevity trends, it is important to not only set reasonable spending limits, but also stick to them. If you fail to do so, the best laid retirement plans will likely come undone. In other words, you want to avoid living beyond your means. To do so requires discipline, which can be developed by establishing a budget. A budget allows you to avoid surprises while making any necessary adjustments. In other words, it keeps your plan realistic. Remember to empower yourself. Take charge by learning all that you can about life in retirement. For as Ben Franklin is quoted as saying, an investment in knowledge always pays the best interest. It's your money. Nobody will care as much about your future as you do. Remember, it is better to strategize than to improvise. In closing, thanks to my guest, Kristin Nordahl, for appearing on this program.
Thank you, Ramsey. It was a pleasure to see you.
Pleasure is all mine.
Thank you.
And thank you, as usual, thank you to you, our viewers, for watching Your Money, Your Life. My name is Attorney Ramsey Bahrawy, Building Your Trusts.